Hi guys, a video. I get lots of requests on what we do in our room. Do we do updates and things like that? And what happens to a new trader when they come in the community? Well, what I actually do is every week we do induction sessions, and last Monday was no different. It was about risk management, and what you're about to see that follows this is an uncut version of just what we do, and it will teach for you where to put the stop and why you have to put the stop there, what's STE and why you need it, stop to entry, why it's a good idea to take half off, insure your trade so it's risk-free. And then once you get going, how to use fractal reversals to maximize your profit. This video will also show you how we put this into practice live, because we use live charts all the time. Video is about 40 minutes, but it actually takes you through the teaching and the detail of exactly what to do, when to do it, how to do it, and why you're going to do it. So it's very, very important. If you struggle with risk, putting your stops in the right place, making sure you maximize your profit, then this will definitely improve your trading. It'll improve your profit retention, and it will reduce your risk while you're trying to maximize your profit. So I hope it's useful. Watch it to the end. There's tips all the way through because it's a live session, live trading and interactive. And we do these little sessions every single week. So if you want to, if this is of interest to you, I'm not sure whether it will be, but if it is of interest to you, let me know. And I can put other ones up. We do them every week. We've got 5 years of recorded videos of every single trade we've done for the past 5 years live, and also all these types of sessions as well. So if you're interested, let me know. Give us some feedback on what you think of the video, and well, without further ado, let's get on, and I'll show you the video. Right, okay, this is a session mainly aimed at kind of the new guys, or a refresher for everybody else. Just turn this off. It's about managing your trade in motion, really. And you can do it in any time frame. Just pick cable because that's the screen that we actually had up. One thing I want to cover is on the tickets I put in sometimes you'll see the word STE, stop to entry. The other thing that we do, as well as stop to entry, I'll explain these in a minute, we take half off and insure our risk. So I'll explain when we're trading live, that's what we should be doing. So I'm getting some feedback and making sure your absolute stops are in the right place. I think yesterday, Monday, was a prime example where we did a trade in the room and half the room lost money and the other half of the room won when we did the Euro Japani and Pound Japani. And that's because people are putting the stops in the wrong place. Not watching, really stabbing at the trades, and not really thinking about risk management. What I mean by risk management is there's an absolute reason why that stop is there. And the stop is there on the basis that we do not believe the market is going to breach that particular point. And there's a rationale on that. And people weren't following it yesterday and they got stopped out on a winning trade, which is horrific, really. You should never, getting stopped on a winning trade's obviously a terrible feeling for people. So first of all, what we're going to cover is why we put a stop in a certain place. Once the market is in motion, when do we take half off and when do we stop to entry? And there's reasons for all these things that we actually do that. So the first thing, stops. So there's a trade here. I'll just switch this on and you'll be able to see there's a break of this bar here. So a break of that bar and the stop was above here. Now, so let's say you're going to take a break of this bar, for instance. The way we put stops in, it doesn't matter the time frame, any time frame will do. The rule is exactly the same. So if we take a break of this bar, for instance, be it 15-minute bar or otherwise, we want to know where our stop is going to be. And the rule, I need to put the trade on for the moment. The rule is you need to understand the spread. In this case, it's a 1 pip spread. So your stop has to be the spread distance from the last swing high if you're shorting here. So the spread is 1. So it's 1 pip is your stop on the spread. However, if the market comes back up and double taps this level here, this resistance level here, if you use just the spread, you will get stopped out. So you add 1 pip above the spread. So some markets, for instance, pound Japani that we were trading yesterday, as an illustration, will be 3 pip spread. So if you were trading pound Japanese yen, then your stop here would be 3 pips plus 1. So always remember your stop has to be the spread plus 1 pip. So in this case, it's a 1 pip spread, so it's 2 pips. So you mark, if you trade in this, you'd kind of go in at 72. You look at the top of the candle, which is 86.3. Always when you are putting the stop, you always round up, so you call that 84. That's 86, so you call that 87. You got 1 pip for the spread plus 1 pip for the stop, and therefore it's 18. You would have this stop here at 89 when you were trading. So that is the correct way to put a stop in. If you come to the market and find that you're a little bit late, we'll talk about getting in late in a minute. You stop. If you see the stop, it has to be the same stop. The reason there's a stop there for that exact reason that I've said. For this little margin here, to stop a double tap onto that top of the candle being, so you're not taken out to the market. So if you were, for instance, an example here, the market's come up and you've done your trade and you're going short here, and your stop needs to be a couple of pips above here to stop this exact motion in play. The market coming up, double tap, and then going back down. So if you were in the market here, then you would not have been stopped out. The market would have relaxed and continued going down. So I can't emphasize enough, your stops, you need to calculate your stops accurately. And when you see things in the screen, then those stops need to be put in play. You can see here, you can see exactly where we took this morning. And there's fractal breaks, other fractal breaks here that we've took as well. That was a fractal break here that was taken again, and we did that live on a one-to-ones this morning. Aussie USD, we're short on the backside of the Aussie USD as well as the FTSE. So today, if you've been following some of the trades or if you've been using the strategies that we've got, there is at least 4% on the table today. Let's go back. I'm going to do a recap of this. People said it might be useful for me to do a montage of some of the trades that I do, screenshot it, and then chat through why we did these particular things. So I'm going to do that. So I'm just going to move some of these things out the way. Right, we'll turn this off again. Right, so that's why the reason for stops, to prevent a double tap reversal, or if the stop is being put in place and you are following a trade, then your stop must be in the same place. So The next thing I'd like to talk about is if you miss a trade. Risk, and this is about the risk management, and especially if, like for instance here, I'll just move this to one side. Can we just move this to one side a bit? Oh, wrong way. Let me get this right. That's the way I need to go, isn't it? And go back here. So there we go. That's the actual trade there as an example. If you're wanting to get into a trade and you come to the market, and so that's still risk management, you come into the market late and you miss that entry. If you notice these all these candles, market, this one, the market opens up here, comes all the way down here for a test low, and then stops here. Market opens, comes all the way down, and stops here. So on many occasions, you may think, damn, I've missed the trade, because you'll see an entry here. However, the market might be here, might be somewhere down here, and you think, oh, I've missed it. A great technique is if you've missed it, you may well have missed it, and that's just something that you'll have to acknowledge. You either go in and keep your stop where this is, or a little tip on risk management is you, as the market's down here, you set your entry at the same place where it should have been. In this case was 12, 6, 7, 2, because you often find within every candle, if you look at the candle, it closes here and then momentarily will open up a little bit higher, and you quite often find within that switch between candle time frames it can click you in. And although you think you might have missed it here, the market's closed here, you quite often just get a wee blip and you can get back in again. So you can get back in at the entry that you wanted to. And if you can't get back in the entry that you wanted to, you still can actually get in lower, but your stop needs to be in the same place. So there's a little tip for getting in, managing your risk. In other words, you one-to-one, keeping your stop the same. Now, when there's a couple of things that we can do. You'll see on tickets, I'm going to adjust them with a little bit more information on. You see the tickets and it says STE on them. STE means stop to entry. So there are a couple of things that you can do when the market runs off. If you want to maximize trades and maybe start stacking trades, as you can see, I've only got 2 trades left on here. Both of them are completely risk-free now, and we're heading off down here. And I forget what this one was now. Is it 18 or 17? 17 pip stop. So on this one, we've done quite well really on that one particular trade alone. It's already 2.5% up. But where the market runs down, when you got the market running, we'll just call it, this is a hypothetical trade, the market moves off. Now, there are a few things you can do. There are reasons why you would take half off and leave a stop. And when you are running a trade into a potential resistance area, so the market's run up here, and you can see it's a very small resistance area here. You'll notice I've deleted the others because I'm doing a one-to-one. These are all the little resistance areas here that you want to watch out for market pullbacks. So if you want to take half off, and you can see that's a resistance area here. So as the market's coming down towards here, the 2 things you could do, you could actually put a stop to entry. But if you can see there's resistance in the way, the chances are when the market comes back down to this level, you'll find it potentially has a little blip. And that little blip can take a stop to entry away. So when you're getting halfway along, you can move your stop to entry. When you see something in the way, you never move a stop to entry when you've got resistance in the way here. Okay, if you can't see a full, in other words, nothing in the way of a pullback or a resistance, when there's nothing in the way, then you can move a stop to entry. If there is something in the way, then if you want to put in some risk management, then you would take half off. So your market is probably 3/4 of the way up here, and then you would take half off. You take half off round about here, which should give you about 1/3%, because you're not all the way down to get 0.5%. And then you leave your stop where it is. So you've made some money, you've not quite insured a full loss, but your potential loss is only about a 1/4%, 1/3% if you get stopped out, because you've already made a third here and you've only got a third to stop yourself out. So you took a wee bit of profit, and then you win for the market because you got this resistance to blip. The market did blip up here. It then provided a fractal break. I'll put them on so you can see. It then provided a fractal break here, which is another tradable trade which we traded. So that's another tradable trade. So there's your blip, and you're watching the market. You're in the market. You've had that blip, and now you know, because I've had that blip up, you now know that that's going to be your stop if this breaks here. So your next trade would be a break here, and it would be check your levels. Well, at 0.1, I'd just round that. I wouldn't round that up 0.9. That's close enough to 76. So you'd have that one now at 78. And that would be your next trade. So this is a trade where you've took a little bit off, and this is your next trade coming down. Now, your next trade coming down, you don't know that this is here. You don't know that this is here. So when the market gets down to here, you can then put a stop to entry because there's nothing in the way. There's something in the way here. Previous action bounced. So previous action bounced, it's likely to happen again. There's no previous action here because as you are taking the trade, there is nothing in the way. Nothing in the way. This is post the trade. So there's nothing in the way. So when the market comes down to here, you are then clear to put a stop to entry. You will probably you could easily see a bounce, but you're not expecting, with the market running down, that to be broken. So you can watch this market as it comes down to here. You could take another half off if you wish, or on this case, you could take a full stop to entry because there's nothing in the way. There is something in the way here, so half off and ensure any potential returns. Or the other thing, of course, on the risk management side is believe in your stop, and you just do not move your. You don't have to move your stop. If you believe the market is going to, in this case, run all the way down to here. If you look at here as a trader, and this is one of the things, you've got to look at the higher time frame. Do I believe this market's in a bit of a free fall? Well, the last significant breakaway was down here. And as you can see, there's nothing in on the next previous trade, nothing in the way of this market falling all the way down to the bottom. Going back a little bit further, you can see you've probably got some area at 24, starting around about 20, 25, 24 in the way. This is all about you managing your risk, why you keep moving your risk down. I'll put that line in just so you can see. It's a little slither there into there. That's where the next area of issue might actually be. So let's get back into here. You can see the market had a little hesitation and a bounce there. So the rules are, markets come down previously to your entry, so that the market is likely in the future to bounce off that level. When your target is below an area of resistance and you're getting down towards that resistance area, that's where you take half off. When you're doing a trade and there's nothing in the way, so there's nothing here in the way, you can see here there's nothing in the way between that trade and the floor here, nothing in the way. So that's a point where you can put stop to entry if you wish. But you also, if you wish to, is you could insure that risk. So once it gets all the way down to there, if you've got £10 a point on, for instance, you take £5 a point off for profit and you're leaving half the leverage, £5 in the market. Now, what that does is it insures that risk. In other words, if the market comes back up and knocks you out here, then you are risk-free, because you've already took £5 a point at the full ratio of 1-to-1. So if you lose £5 a point up here, then it's zero, no loss, no gain. So that's a way of taking half off, insuring your risk, to give it half the leverage to go further down. So now that is risk-free. Your risk in the market is next to zero. Now the market's broken here, that half off can now be put stop to entry, because the market has now moved off and broken that resistance. So now you have two trades in here. You took profit on this one. You've got your stop to entry, so you're guaranteed to lose absolutely nothing, and you've banked profit. This one, you have profit, and you're guaranteed not to lose the trade. So your next trade is here. Swing low 80, so 90s, 68, 69, 70. So your next trade is here, and you got full 1%. The market has bounced before here. So this is where the chances are markets usually always do a little test. Market started to come off. It's come down towards this area and had a very weak test. So when the market comes down to here, you then could take half off and reduce your risk here if you wish. You can keep your stop where it is, or you can take half off. I'm just showing you all the different ways to risk manage your account. The absolutely key to all trading isn't to try and go for the big win or ridiculous statements like I always go for 1-to-2 or 1-to-3 and all that crap. It's about preservation of capital is king. If you always can preserve your capital, ensure your trade, then the strategy will take care of your bank balance. If the strategy always wins more than 50% of the time, and you're always capable and competent of managing your risk, then you will always win money. You'll always make money. So as you can see here, the market did blip up, and then nothing, no real challenge. And then you've got the blip up. You can see the blip here, so you know where your stop's going to be for your next trade. And then you do your next trade here. All the time, you never, ever got more than, that's 59, 60, 61. You've never, ever got more than 1% risk on the table, and you've done 4 trades, and you're capitalizing on all those trades. The market, there's no space here again. So when the market comes down to here, 2 things you want to do. And I'm doing this on the basis you're running for a big long target. You can see all these have made 1%, 2%, 3%, 4% as we're going down. That's hindsight trading, and that's all very good. But we don't trade in hindsight. We trade real markets. So we trade real markets and we preserve our capital. As an illustration to that, there's each trade. We've been stopped out for all the money that we made on that fractal reversal here, which leads me quite nicely into how to follow your stops down as well. So I won't keep going over the breakout here, then the next breakout here, then the next breakout here. We've got so close here, the market's more or less, as you can see, more or less done that very big move that we traded. So today, the actual move, the market actually moved 51 pips, which is great. And we use a 17 pip stop and then much smaller stops along the way. If you are doing multiple trades and managing your risk, there is another way of also protecting your capital. As you can see, these fractal reversals here. There's one there and one here as well. Then another one here. And then there's this one there as well. So you can, as you noticed that I did here, if I can get that screen up, put my, that wasn't the one, which one was it? 11, 13, oh, didn't take a screenshot of that one. I did put my reversal here. So as I'm coming down, my stops were progressively getting moved down on the top of this fractal reversal. The reason for that is, as we were getting closer and closer to the target, this fractal reversal is an indication of the last previous swing high. So really, your fractal reverse, this fractal reversal is a really good way of progressively bringing your stop down. So if you're bringing your stop down and leaving everything in the market, as you saw that I did, so from here to here, you know, if you did that, that was 35 pip win, for a 24 pip win, a 20 pip win, and a 13 pip win. So you can see by using this, you are collecting 35 pips, 24, 20, 13, while managing your, that obviously completely risk-free. Completely risk-free, completely risk-free, completely risk-free, completely risk-free, and you bank 35, 24, 20, and 13 pips. An excellent way of managing risk, preserving your capital, and giving you less stress in the marketplace when you are managing your trades. A really good way of managing risk. And this works on any time frame, making sure that, and recapping that, when do you use half off and when do you use stop to entry, or believe in the whole trade. Now, I mean, by believe in the whole trade, there's a big gap here. So I believe in that whole trade. When there's still a big gap, believe in that trade. When I get here, then we're very close. I will then manage the risk very carefully by taking half off or making my stop to entry. And when we get very close to here, I'll bring all my stops down, as you saw, into here, and then we got clicked out for a nice profit. So a recap on half off. Half off would be running into previous resistance here, absolutely key. Half off would be if you run into a daily pivot on an index. So you've got, let's say you've traded this and you've got Camarilla breakout short here. Well, the chances are you're going to get a blip off that. So you do want to manage your risk on that one. If you're running into a larger time frame Fibonacci retrace, might be a 60, especially be careful of a 61.8. retrace level, very common level that people buy and sell from. So if you're heading down towards this level, and that was a 61% Fibo, then you want to be very, very careful. Doesn't mean to say it will hold. It could go through and continue through. But there is a very strong one, which is even more relevant for your risk management, is the 78.6% Fibo. And there's quite a well understood trading rule on this one, is if the market is going to stop and resist, it will do that at the 78.6. If the 78.6 Fibo is breached, then more often than not, the market will continue to 100% retrace. So all these are parts of risk management that you need to understand. Be careful of the 61.8 if you're trying to push through it to take a profit. Be very wary of the 78.6. Be very wary of that one if you're trying to go for a target that is below 78.6. As the market comes down to that, try as much as you practically can to take the profit at 78.6 or make your trade risk-free. Absolutely vitally important. We're just going to flick now to the Aussie USD. So I'm just doing this live. This was a trade here. We got stopped out from up here for a nice profit, and then this was the extra trade that we put in that we have been clicked onto. Now this trade is above the other. This trade is actually this trade. Well, this trade was I just can't remember what this trade one was. It should have been high. I don't know why it slipped, doesn't it? This trade should have been a bit higher on this Fibonacci here. Therefore, we should be 2 pips higher up here. So I'm just going to quickly move that now because I need to go at extra risk. We've been stopped. I don't know why the market slipped. You can see it slipped. Let's go back to here. Bonk. Right. So I don't mean it too complicated. A recap. Half off when you're coming into a Fibo or a pivot or a Fibo or a pivot or a previous resistance. Half off. Leave your stop where it is. If there is nothing in the way of your trade, like this one, this particular trade, then you don't need to take half off at all. But the rule is, once you get down to your 1%, obviously you can take your profit if you wish. You then can move your stop to entry, because if the market has made a big run here and here, it's likely to do a little bit of an ATR retrace. That's not a problem. When the market came to here, then you can put your stop to entry once the market hits here. Again, here, there is a bit of resistance here. So on this one, that's when you put stop. That's when you put half off if you're going to do that, because this one's going to have a potential bounce, and it did. Bit of a weak one. This one, nothing in the way. So this one isn't half off. This is leave it to come down to here and then put your stop to entry. Or you can always take you can take the 1%. And as you can see, using fractals as your reversal stop, each one of those worked. And these have all been recorded this morning and all screenshot. I might do a review of these because it just demonstrates live how to manage risk and what to do. My particular choice on these were to leave my top one, as you know, let it run without taking any money off. Take 1% on here, 1% on here, and then run this one as well. So I've got 2% leverage going down and bank 2% here, and then 2% leverage going down there. And then we made a stop out. Where was it, here or here? One of these two. and we got reversed out on these two here for a nice profit. That one obviously for 1%, this one for an awful lot more. This one was, I think, 2.4%, wasn't it? Something like that. 17 pip stop, yeah. Just over 2% that one. So hopefully I've tried to keep it as simple as possible. The rule is stops have to be on against the previous swing high, swing low, plus the spread, plus 1. Whatever the spread is, plus 1. Stop you getting stopped out. Rule for risk management, if you're going to employ risk management, is half off when you're running into resistance or on a pivot or into a Fibonacci. If there is none of those in your way, then you can do stop to entry once the market has hit the full target, and it's very unlikely it's going to get retested. Again, this one, there's resistance here, so that was if you were using these hard rules of always engaging in stop to entry or half off, when the market comes down to this level, you're taking half off and leaving your stop where it is, and that worked as well. This next level is one that there's nothing in the way, therefore you put stop to entry once you hit this here, and there's your stop to entry here. Using those techniques and those rules, none of these trades would have been stopped out, and every single one of these trades made money, and you watched it make money all the way down to here where the stop was, down here. Okay, are there any questions on what I've explained on risk management, i.e. putting your stops in play, when to use STE, when to take half off? No,
I got it all.
Okay, again, you don't have to do stop to entry and you don't have to take half off, but what you have to do, and a rule that I have, is we always use 1% as our risk, 1-to-1. If I'm going to stack trades like we've done this morning, I never want to have more than 1.5% at risk. So I have to do something with these trades if I'm going to do that. And the way that I manage this is I believe in my trades, so I do put my stops, keep moving my progressive stops down to these levels. I keep doing that until I get stopped out.
What's your thoughts on trading stop loss, Steve?
Bullshit.
Bullshit.
Yeah, don't use them.
Yeah.
Well, what do they do? All it does is trade how you got in. It makes no adjustment whatsoever for market action and how markets respond to resistances, fibbles or pivots. It's just a dumb follow.
Yeah, I tried them once and it cut off my profit. I didn't really try it again after that. I just wondered what you thought.
Well, if let's without being making a daft comment that I did really, if you trail a stop, if I take this as a stop, you can see this stop, and I start trailing this stop down, you can see how would this actually have gone, this particular one. They would have been stopped out by trailing. It took no recognition of what happens with resistance, none whatsoever. It's just trailing a stop, and then you get stopped out. Trailing stops do have the use. Certainly have the use in swing trades, where if you've got quite a long swing and you got a big, quite a big stop, and then you're trailing. Many people who do swing trades, and the trades that last, for me, trades that last more than 1 day, people do a trailing stop because they don't use the intelligence to monitor the market. They just trail it and trail it and trail it until the market turns on them. If you've got a bit of analytical about you, and we know things that maybe or we use tools that other rooms maybe don't. In other words, we have fractals and reversals and Iconashes. We know that if this structure is broken, then there's something wrong. Now, this is our first indication that something is amiss, because we do not generally, if the market's going in your direction, we generally do not see a fractal reverse without a significant move. But again, when markets move in a small direction here, you get that confluence. It nearly always goes back into the same direction. If we're managing our risk, then we only move our stops when we have the next fractal break. So the market's moved up here, our stops are here. There is no fractal break until there. When the fractal break's in place, then that's the stop and we move it down. Therefore, we are responding to price action, not just trailing a number down behind a stop. So my view, never use a trailing stop, because we've got a more intelligent way of doing it. If I'm going to be away from the screen, then I might put a trailing stop in play or just take the money. If I'm going to be away and the market's going to run, then you can't do all this movement. But if I was going to do a trailing stop, then it would only be when I don't want to take the profit and I think the market's going to run for over a day, and I want to see as much as I can get. But if I was going to run a trailing stop, wherever position I was in, I'd take half off and then run the trailing stop. So if I do get stopped out, I've already made half profit. I've already insured the trade. If the trailing stop starts coming in my direction, coming down, it just means that I've insured the stop up here. So as the stop keeps coming down, all I can do is make money if I get stopped out. So if you're going to run a trailing stop, take half off. It's a short answer. Okay. I hope that helps. The key thing is half off when you're hitting resistance, be previous bounce, Fibbo or pivot, and when you've got a clear trade that has none of those things, then that's when you do stop to entry. You take half off and stop to entry. Half off, keep your stop with resistance, with no risk in its way. Half off and stop to entry. Those are the hard rules. Okay, guys? Any questions? Okie doke. Well, I hope that's been useful and the rule. And when you see any tickets, when you see STE, or when you if you see STE or half off, then you know the rule on the ticket. Okay. Cheers, guys. 3, 2, 1. For all of you people who got to the end, very well done. Sometimes I do go on in the videos, but it's very, very important, I think, that people understand risk management. If you find this useful, please subscribe, share with your friends, give me some feedback. It will give me the encouragement to do a few more. I've got thousands of hours of recordings, lots and lots of lessons. I just really want to help people. If you find it useful, please subscribe, share with your friends, and make sure you hit the alarm bell. And hopefully my next video, you'll be alerted straight away. If there's any questions that you've got whatsoever about trading, anything you want, just let me know. And if I can answer it, then I will. Hope you enjoyed it, guys. Bye-bye.